Many renowned economists have become inflationists in recent times. What's more is that many are expecting anemic economic growth, and this makes perfect sense given the debt-laden state of Western economies. This so-called stagflationary environment is one we have seen before, and today we explore the best performing assets in that environment. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. Now, the excellent team in Gold We Trust have released a fabulous treasure trove of economic data, which I've really enjoyed geeking out on. The link is in the description if you do want to take a look. Two of their charts deal with asset performance in a stagflationary environment. And I think this information is absolutely key to being able to navigate the uncertain future we all face and understanding where real gains can be achieved. Now, they examine the stagflationary periods that were seen at 5 different points through from 1959 right through to 1982. And they then average the actual gains of the different asset classes for those different periods. So I thought this was absolutely fascinating and well worth understanding. Now, we can see the significant inflation in consumer prices in the US in this chart, and we know that central bankers and governments will certainly have a tolerance towards letting inflation run hot. The impact is, of course, more inequality, which is why this data that Ronnie, Mark and their team have put together is so important for all to understand. So if we take the best average nominal and the best average real or inflation adjusted performance from these periods, we can see that WTI oil was the best performer, averaging a 78.1% nominal and a 64.3% real gain. Of course, this was largely driven by problems in the Middle East, the Yom Kippur War, and what economist Anthony Sutton terms the created energy crisis. Nevertheless, we've certainly seen a dramatic rebound in the oil price recently, and expectations regarding underinvestment in the sector are encouraging many to expect 3-figure oil prices in the not too distant future. Of course, oil remains a key cost-push inflationary driver as well. The second best performer was gold, generating an average nominal return of 38.7% and an average real return of 24.9%, while silver came in third with an average nominal gain of 26.9% and a real gain of 13.1%. The S&P 500 showed an average 20.8% nominally and just 7% in real terms. But of course, there was wide sector variations within the equities market, which we'll look at in a moment. The dollar showed a positive nominal average gain, but was down minus 0.1% in real terms. And so while we've seen commodities really take off in recent times, as this great tweet from Reddit investors shows, prior gains in these stagflationary environments were up an average 12.3% nominally and minus 1.5% in real terms for the S&P GSCI index. And so looking at equity sector performance, the best returns in these periods were achieved in the materials sector, attaining nominal average growth of 31.4% and real growth of 17.6%. We've certainly already seen some significant gains in the copper, iron ore, lumber and steel sectors. Consumer discretionary stocks gained over 12% in real terms, although much may depend upon what takes place with real wage growth. For we know central bankers love inflation in everything but wages. Meanwhile, real gains were achieved in industrial stocks, energy, healthcare and financials, respectively. Furthermore, firms with high debt but significant pricing power would seem well placed for a stagflationary environment. Additionally, some of the top performers in the Weimar hyperinflation were farmers, and we're certainly seeing some of the elites follow in their footsteps. But we're also likely to see relative outperformance of certain emerging markets that don't face the same crushing debt burdens and have much more favourable demographics than aging Western economies. Those that look best suited to benefits around the Indian Ocean and include India, Ethiopia, possibly Iran and even Indonesia. Access to the Indian market is easily available via ETFs such as the Wisdom Tree India Earnings Fund EPI. Yet direct exposure to Ethiopia isn't the easiest, with many of the African ETFs placing much larger weightings on the continent's larger economies such as Nigeria and South Africa. But of course, any potential dollar spike is bad news for emerging markets. And then, of course, there's cryptocurrency. And love it or hate it, the market growth story is quite compelling. Market growth and the world's strictest monetary policy seems to actually create the ideal environment, the ideal recipe for growth. As the author of the Bitcoin Standard recently put it, Bitcoin's market value grew around 1 billion% in the last decade. If its next 10 years witness 0.0001% of the growth of the last 10 years, Bitcoin will be bigger than all the world's bond markets. And with forthcoming IPOs of stocks such as Coinbase, it now means you can actually avoid having to hold any crypto if you truly loathe it. Personally, I see the impact of cryptos as very empowering. Just consider how it has helped many in developing countries to avert domestic currency risk, provide a convenient source of saving, and facilitate people's ability to flee totalitarian regimes. Furthermore, it has educated a new generation on the dangers and problems posed by our central planners. Additionally, privacy is going to be a major theme in the years ahead, and while Bitcoin fails to offer real privacy, there are coins such as Monero and Pirate Chain which really do prioritize this together with strict monetary policy. So there we have it. There's some historical data and some other picks that may help us to actually ensure that we can prosper in any stagflationary environment. Of course, all of these trades are potentially vulnerable to a wider deflationary environment, but I certainly do believe in the potential for emerging markets to greatly outgrow the Western economies of the world in years to come. So what do you think? Do let me know your thoughts in the comments below. Thanks so much for watching, and I look forward to seeing you next time. Bye bye.